Hey there, this is Steven Kowitzel with thetradersplan.com. Today I'm going to cover portfolio risk management, and I'm going to show you 3 strategies that will lower your portfolio volatility, allowing you to outperform the market over time. So stay tuned. Okay, I'm going to start with stockcharts.com, and there are a lot of good and free tools on this website. My first rule is I like to invest, or at least have some portion of my money in non-correlated assets to the S&P 500. So when I say non-correlated assets, I mean that means if the market goes up, this thing might be up, it might be down. It doesn't really matter which way the market goes. This thing's going to do its own thing. Inversely or negatively correlated with the market is like stocks and bonds. It means they move in the opposite direction. So if the stock market goes up, the bond is going to go down and vice versa. So I am looking, and obviously correlated, if the market goes up, you're probably going to be up with it. If the market goes down, you're probably going to be down with it. Just like individual stocks are very correlated with the overall market. So I like to add non-correlated assets to the market because I'm a trend follower and I like to follow trends. And sometimes when you have, especially like you did in 2015 and parts of 2016, when you have trendless environments, a lot of times you will see some of these non-correlated assets really start to strengthen based on their own fundamentals. So I'm going to show you what that looks like, or where you can go to kind of create and build your own watch list of non-correlated assets that you can potentially add to your portfolio. So just go to stockcharts.com and go to this little section, this little button down here that says Market Summary. So most of the non-correlated assets, you're looking at things like individual single countries that might not necessarily be as correlated with the S&P 500 as other markets. Or you're looking at commodities, right? A lot of bonds are negatively or inversely correlated with the market, meaning they're going to move in the opposite direction, up or down. So a lot of times what I look for when I really mean non-correlated assets, like I'm going to look at commodity ETFs. I'm going to look at currency ETFs. I'm going to look at single country ETFs. And when I look at them, a lot of times I do like to compare it to the S&P 500 just to know what kind of exposure I'm giving myself. Because if you have a portfolio and everything's going to move with the market, you're not really diversified. Yeah, you might be diversified from single stock risk, right? If you have a lot of stocks and one goes down, you're diversifying yourself out of single stock risk, but you really have not diversified yourself out of market risk or portfolio risk. So here's just a list right here of 20 or 15 commodity ETFs that you can put on your watch list. And all you have to do, or all I do, is wait for the breakout, right? If one of these ETFs is showing real strength and all of a sudden it breaks out to new highs, or it breaks out of a consolidation, or it's sitting on top of support, right? I will look to add that, to potentially invest my money in that, to add it to my portfolio. So you have a list of commodity ETFs right here. You have a list of currency ETFs right here that aren't necessarily correlated with the overall market. So you can really find an ETF on just about anything. And if you want to figure out whether something is correlated to the overall market or not, I have the SPX pulled up right here, and I'm going to show you a tool. You can go down here, scroll down, right? You got the S&P 500, scroll down, and you have this little indicators part right here. Well, if you look in the drop down, there's something that says correlation. So what you want to do is, if you want to figure out if something's correlated to the S&P 500 or the market in general, you'll go to the correlation, and then you'll add the ticker, comma, and then the period of which you wish to see if it's correlated or not. Now, so we'll update it right here. So what I entered is the S&P 500 correlated to emerging markets, that's the iShares EEM, over the last 500 trading periods. Okay, and I like to look back across at least a couple years, because sometimes something can look correlated in the short term, but it's really not over the long term. So what I have right here is below the chart of the S&P 500, I have this little correlation chart. Now, if you have a correlation of 1, that means you are directly correlated with that market, right? So that means if the market's going up, whatever that security is going up. If you have a correlation of 0, it means you are not correlated with that market, at least over that time period. And if you have a correlation of -1, it means they're moving in opposite directions, kind of like stocks and bonds, mostly move in opposite directions. So you can see over time that emerging markets, typically if something is between -0.25 and 0.25, it's really floundering around the middle line. That's showing me over time that it's not really correlated to the S&P 500. So something I like, something that I'll put on my watch list of non-correlated assets. You can do other things. So you have emerging markets. You can even do a stock ticker like Facebook, right? So I just FB. So you can see there for a while here. Let me go over the last 500 trading periods. So you can see there for a while that it was trading pretty high correlation with the overall market, and as of recently, it isn't. But I'd say most individual stocks, especially if they're growth stocks, they're going to trade with the overall market. However, you can look at some different sectors like XLU, the utilities spider sector ETF, and you can see here's the interesting thing. Therefore, if I go back to 500 sessions, actually that really doesn't look like 500 sessions. Let's go back 2 years. Okay. There we got that. Let's update that. Okay, so you can see here as of lately, for the most part, utilities are correlated with the S&P 500, but as of lately, they haven't been, right? The markets have been going down and utilities have been showing strength. So, but that just goes to show you there can be pockets of non-correlation, but typically when you're dealing with individual stocks, they're going to follow the market, right? 3 out of 4 stocks are going to move with the market. That's why I'm trying to show you things like currencies and commodities, because they're really going to move based on the fundamentals of that country or on the fundamentals of the supply and demand of the commodity, right? So if you really want to get fancy, so that's just kind of a quick and easy tool, to show you, okay, is it correlated with the S&P 500 or not? If you really want to get fancy and you want to be like, okay, I want to look at what my portfolio, how correlated it is, the whole portfolio, not just a single stock, to the overall market. I was just kind of messing around and I found this. Go to the Select Spiders ETF home website, and then you go to Tools, and then you drop down and you go to this correlation tracker, right? Click on the correlation tracker and it'll take you to this page. And you want to be on the portfolio to portfolio, and you can kind of play around. There's some really neat stuff on this correlation tracker. But what I basically did was I just kind of entered in a dummy portfolio, right? You got GE stock, you got gold, you got iShares China, you got the yen, you got Facebook, right? Let's just say that's a portfolio. And what I did was I compared it to the SPY, the S&P 500 ETF, right? So I'm comparing my portfolio or my dummy portfolio to the overall market to see how exposed am I really to the overall markets. Now let's look and see. You click the plot button. Now what it does is it compares my portfolio 1 to portfolio 2, which is the S&P 500, and it's got a correlation of 0.79. So basically what that means is 4 out of 5 days, if the market's up, I'm going to be up. 4 out of 5 days, if the market's down, I'm likely to be down. So it's pretty heavily correlated with the overall market. Not 100%, but you got some correlation in there. And it's okay if you're really correlated, if that's what you want to be or not. All I'm saying is if we want to diversify our portfolio and limit the volatility, it helps to add some of these extras, right? But when I say add these to your portfolio, I'm not saying just go out and buy something just because it's not following or not tracking the S&P 500. Make sure that asset or whatever you buy is showing strength, right? Buy the strong, sell the weak. So don't go out and just buy anything. Make sure you're buying strong, solid ETFs or sectors, currencies, whatever, popping out of solid consolidations or are sitting on a support line and you feel pretty good about the risk-to-reward ratio. Okay, so rule number 1, buying non-correlated assets to help manage our portfolio risk management. Rule number 2, I was reading a trend following book, and I'm always reading these books, and I really never looked at it like this. Rule number 2 is be willing to short markets, right? And I know a lot of people, some people don't like to short markets, but the strongest trend in 2015, the strongest trend that I could find in sectors was oil, and it wasn't going up, it was going down. Meaning, if I would have had, and I didn't, by the way, of course not, I didn't short oil at $100, but if I would have had, all my short ETFs in front of me, and I would have seen one of these ETFs breaking out, right, of a consolidation, meaning the price of oil is breaking down because it's an inverse, right, then I could have jumped on it. Now, the S&P 500 in 2015 was relatively flat. I mean, he had a very, very rough last 2 quarters, but it ended pretty close to being flat. So at the end of the day, if you have an overall flat market, if you were able to sit through it, and let's just say you own the S&P 500, but you had a couple positions that really weren't correlated, like you would have shorted oil, or you would have been long a certain currency, or whatever the case is, that's what's going to help you not only lower the volatility, but increase your returns over time. So be willing to short the market. There is, I have about 20 single ETFs, and I'm going to give you here in a second. I'm going to give you all the tickers if you want to build your own little watch list. But I have about 20 ETFs of short markets that I look at, right? So because these are short ETFs, I look at them to break out, meaning the sector that it's shorting is breaking down. You can easily just go to top inverse ETFs. So I've already done this, right? Just Google top inverse ETFs. Here's a list of the top 72 inverse ETFs. I don't like to have too much leverage on these lists. I really like to just kind of have a list of the actual sector or just the regular inverse ETF. But I mean, there's tons of inverse ETFs that you can find if you want to build your own list. Now, what I look for when I'm looking to buy an inverse ETF or short a market, so this right here, this is EFZ, and this is just an example. This is the ProShares short EFA, right? The EFA is basically the world ETF, right, minus the US. So you can see right here from 2012 to 2013, there was a really strong downtrend because that was a really powerful time in the market, right? They're moving in opposite directions. But now all of a sudden, right, you're starting to get this little bottoming pattern, right? And you can tell if you want to draw these lines, it's had a couple breakouts. Now the breakouts haven't done too well, but here's something I'm noticing. You can buy the breakouts or you can buy the support. Right now, this EFA short, this short world market ETF, sitting on the 200-day moving average. It came down, boom, found support. It tried to bounce out, boom, came down, found support. It's like a couple percent above it. So if you were bearish, right, you think the market's going to take another leg down, and this short ETF is looking like it's finding support. It's got the 50-day above the 200-day. Like it's trending, even though it's not a beautiful trend like this over here, which is a beautiful trend. It is starting to slowly trend. I mean, if you were bearish, this would be an opportunity to hop on board and see if the market takes another leg down. Or you could just, buy these, you could just buy these as they break out of price consolidations or just whatever the case is. But it really doesn't have to be much more complicated than that. So, what is the right amount to be short or to have non-correlated assets in your portfolio? It really just depends, right? Like if I'm seeing, like in 2015, for example, when the markets are basically trading sideways or down, and I'm seeing a bunch of these other things popping, right? Strong trends in different commodities or shorting oil or whatever the case is. I'm going to load up on more of those because that's what's working, right? So again, I wouldn't just short something to short something or buy something to buy something, just to have it non-correlated. Make sure that you buy any investment you buy. You want to buy it at the right place on the chart at the right time. That way you can increase your probability of success. So that was the first 2 rules. Here in just a second, I'm going to show you, and I'm going to give you the list of these ETFs. I'm going to show you rule number 3, and we're going to go through this together because I have some math I want to show you, so stay tuned. Okay, so I created this chart, it is kind of a guideline. So you don't have to follow this, and there will be times that I'm invested in more non-correlated assets than, long the market. So I'm the kind of guy, I'm going to have 4 or 5 stocks in my IRA instead of maybe having 15, 20. Because at that point in time, if you own that many stocks, you really just own the market. You might as well buy the SPY, the S&P 500. So I might own 4 or 5 things. Let's say I'm long the market or I'm bullish the market. I'm own 3 stocks or ETFs that might be correlated to the market and go long. I might own 1 investment that is not correlated to the market, but is still going up, because remember, we're not just buying blind here. We're going to buy things that are going up. And then, of course, I might be short 1 market or 2 if I'm seeing a currency or a sector, like the biotechs right now are getting beaten up, or just something that is really looking like it's about to roll over. I'll go ahead and short that market. So, again, it's just a different way of looking at it when you think of sector diversification, stock diversification. Well, I like to look at it as, a little bit different. So be willing to short the markets. Rule number 2, I told you I would give you a list of the ETFs. Now, these are non-leveraged ETF, or at least most of them are. These are a list of the ETFs I look at when I'm looking to potentially add a short. I look at these, I'm like, okay, these are inverse ETFs, which means, they're going up as the market's going down. Like, what is the strongest looking chart? What is the strongest looking sector? What is breaking out? And then I buy it, right? That's my short right here. So you can pause this video, pause this training. You don't have to do the research. I've done it all for you. You can write these tickers down. Obviously, if you want to, you can add leverage. But I'm not really, there are a lot of leverage ETFs out there. And typically, I don't like to use too much leverage in too many places, right? So these are just some ideas. Now, rule number 3, and I told you about it, don't risk more than 2% of your account balance on a single trade. Now, what does that mean? So, I drew this little chart right here and just kind of show you the example. So if you have an account balance of $10,000, you want 4 positions. Let's say 4 $2,500 positions. You take that number of positions and multiply it by 2%, and that's your stop loss on each trade. So that means that if one of your $2,500 positions hits an 8% stop loss, and let's just say the other 3 are flat, your whole account is only down 2%, even if you take an 8% stop loss on a single trade. So that's what I mean by saying don't risk more than 2% account balance on a single trade. It doesn't mean, buy 50 long shots and, if you lose everything, you lose it. No, don't look at it like that. Just diversify it and do this quick math right here. So if, let's say you have a $25,000 portfolio, you got 5 and you want 5 positions, you have to decide the number of positions you want that you're comfortable with. Just multiply it by 2. So what that means is you can take a 10% stop loss on a single one of these $5,000 positions, and your whole account balance will only be down 2%, assuming the other 4 positions stayed flat. Same thing, one more example, on a $100,000 account balance, say you have 8 positions, 8 times 2%, a 16% stop loss would... So now I don't ever recommend taking more than an 8 to 10% loss, but this is just for example, if you wanted to be a little bit more diversified, right? You could take, and you had 8 positions, you could take a 16% loss on a single position, and your whole $100,000 account would only be down 2% or $2,000 down to $98,000. So I gave you 3 rules to portfolio risk management. Rule number 1 is buy non-correlated assets. Rule number 2 is be willing to short the markets, and I gave you a list of my ETFs. And rule number 3 is don't risk more than 2% of your account balance per trade. So I hope this was helpful. If you like this education that I presented to you, please comment below. You can subscribe to the YouTube channel. Hit the like button. If you're interested in seeing my top enter and exit strategies with stocks and ETF, stay tuned. Hey traders, this is Steven Kowitzel with thetradersplan.com. I hope you enjoyed my most recent video lesson. There's going to be many more to come. I talk to traders all the time, and they keep asking me the same thing. They say, Steven, I really need help timing when to get in a stock and when to get out of stock, because I believe I'm losing money when I shouldn't be. So I designed and created the Savvy Trader course to really help you pinpoint with accuracy what is the best time to get in and out of a stock or an ETF that gives you the highest probability of success. And as a bonus video, I want to show you one quick trick. It's really, really easy to show you how to pick the exact bottom in a stock or an ETF. So click the button below or to the left or to the right of this video. I don't know where it's at. Just click it and get your free copy of the Savvy Trader course. I'll see you on the inside.